BlackRock is crushing silver miners. Silver $94 proof. Most people think silver moves when social media gets loud. They think it's retail, speculation, noise. But what if that story is wrong? What if silver is moving because the people who need it, not the people who trade it, are starting to scramble behind closed doors? And while the public is distracted by mega cap headlines, while money is herded into the same crowded trades, something else is tightening, quietly, structurally, and far more dangerously than charts are showing. Because when physical demand takes control, paper narratives don't disappear, they crack. And when that happens, it's not silver that moves first, it's the pressure inside the system. And the sector being quietly suffocated right now may be the very place the next violent rotation begins. But only after something breaks. For most people watching the silver market, the story seems familiar. When prices move, headlines quickly explain it away as retail excitement, online chatter, or short-term speculation. Commentators point to internet forums, viral posts, or sudden spikes in trading volume. It feels comfortable. It feels controllable. And most importantly, it feels small. But that explanation no longer fits what is happening beneath the surface. Those who study physical markets rather than just price charts are seeing a different picture. They are watching a market that is beginning to behave less like a speculative asset and more like a strategic material under pressure. In these environments, opinion matters less, delivery starts to matter more, contracts matter more, procurement matters more, and the people involved are not day traders. They are manufacturers, refiners, and industrial buyers who cannot simply exit a position when conditions change. This is the first warning sign serious decision makers look for. When price action begins to disconnect from narrative explanations, it often means the real drivers are no longer public. In recent months, silver has shown repeated signs of this shift. Instead of sharp, short-lived spikes tied to news cycles, the market has displayed steady resilience even during periods when mainstream commentary turns negative. This type of behavior is typical when demand is being pulled by necessity rather than enthusiasm. In physical markets, buyers do not ask whether a story is popular. They ask whether metal can be sourced. At the same time, mainstream financial coverage has become increasingly selective. Public attention is consistently directed toward a narrow group of mega-capitalization technology companies and index-heavy narratives. These sectors are framed as the entire economy. They dominate airtime, headlines, and conference stages. Meanwhile, developments in resources are either minimized, dismissed, or ignored. To those trained in capital cycle analysis, this imbalance is not accidental. Media ecosystems do not operate in isolation. They move alongside capital flows. When capital becomes concentrated in passive structures and technology-weighted products, narratives naturally reinforce those allocations. What receives attention attracts capital. What loses attention loses liquidity. Over time, this creates self-reinforcing loops. Silver sits outside this loop. It is not a platform. It is not a subscription service. It cannot be scaled digitally. It must be mined, refined, transported, and delivered. Its role is not symbolic. It is functional. Silver remains embedded in electronics, power systems, medical applications, advanced manufacturing, and energy infrastructure. These uses do not pause because sentiment changes. They operate on production schedules, contracts, and delivery timelines. When physical demand begins to tighten, it does not announce itself on social media. It shows up first in procurement behavior. Those closest to supply chains begin extending contracts. They seek alternative suppliers. They accept higher premiums. They secure inventory earlier. None of these actions generate viral headlines, but they quietly change the balance of a market. This is why many experienced analysts are increasingly skeptical of retail-driven explanations. Retail participation matters, but it rarely sustains structural trends. Retail acts as ignition. It does not act as engine. What moves long commodity cycles is industrial necessity combined with supply limitations. Silver appears to be entering such a phase. This shift becomes more important when viewed through the lens of modern capital structure. Today, most investment capital no longer moves through individual security selection. It moves through baskets, index products, sector funds, automated flows. These systems are efficient, but they also concentrate money. And concentrated money changes how markets behave. Within this structure, firms such as BlackRock become symbolic, not as villains, but as architects of flow. They design frameworks through which global capital allocates. When those frameworks are heavily weighted toward technology and growth platforms, they naturally underweight physical resource sectors. This is not ideological, it is mechanical. The result is a market where mining companies receive less capital, less attention, and less liquidity than fundamentals alone would suggest. This is why silver miners occupy a critical position in the system. They are the access point through which broader capital eventually enters a physical metal cycle. When miners begin attracting sustained institutional interest, it signals that capital is preparing to rotate out of abstract growth narratives and back into material production. Historically, such rotations rarely occur politely, but before that phase, there's almost always resistance. Narratives shift to portray mining as outdated, excessively risky, or irrelevant. Coverage declines, research budgets shrink, entire sectors fall into neglect. From a structural standpoint, this neglect is not failure, it is preparation. Because neglect creates vulnerability. When capital avoids a sector for long enough, development slows, exploration is cut, new projects are delayed, skilled labor leaves. Financing becomes scarce. These decisions feel rational during periods of low prices, but they quietly construct the conditions for future scarcity. In resource markets, supply is not a tap that can be opened on demand. It is a long chain of approvals, equipment, financing, and political negotiation. Years can pass between price signals and physical response. When demand accelerates faster than this chain can move, price becomes the only balancing mechanism. This is where narrative management becomes most visible. When supply chains tighten, those who benefit from stability prefer attention elsewhere. They emphasize innovation stories, productivity stories, digital futures. They minimize physical constraints. They frame shortages as temporary. They suggest substitution is easy. These narratives maintain confidence in centralized systems. They also delay public recognition of emerging risks. But physical systems do not respond to reassurance. They respond to tonnage, contracts, and delivery windows. The emerging behavior in silver increasingly reflects this reality. Market responses to negative headlines have weakened. Selling pressure appears less effective. Price action is beginning to resemble markets where underlying buyers are absorbing supply regardless of sentiment. For experienced observers, this is a familiar early-stage signal. It is what often appears before visible shortages emerge. At this stage, most participants remain focused on charts, opinions, and forecasts. Few examine procurement flows, hedging costs, or development pipelines. These factors remain largely invisible to the public until disruption makes them impossible to ignore. This is why the silver market currently deserves attention not as a trade, but as a system. A system where physical necessity may be starting to outweigh financial narrative. And when that transition occurs, price is rarely the first thing to break. It is supply behavior. Margin, hedging, and the quiet withdrawal of supply. Most investors believe they understand what happens when exchanges raise margin requirements. The usual explanation is simple. Higher margin forces speculators to reduce leverage, which cools markets and pushes prices down. In purely speculative frenzies, this logic often holds. But silver is no longer behaving like a speculative market. It is beginning to behave like a procurement market. And in procurement markets, margin pressure works very differently. To understand why, one must first understand who the largest consistent participants on the sell side really are. They are not retail traders. They are not online commentators. They are producers, refiners, and institutions managing exposure. These entities do not sell silver because they believe the price will fall. They sell to lock revenue, manage cash flow, hedge future output, and stabilize operations. In other words, much of the structural selling in silver exists because the system requires it to function. This distinction matters because margin requirements apply to sellers just as much as buyers. When margin rises, it does not only restrict speculative longs, it raises the financial cost of maintaining hedges, forward sales, and risk management programs. For a producer, a hedge is not free. It ties up capital, it carries financing costs, it consumes balance sheet flexibility, and when margin requirements rise, these costs increase. Maintaining large, continuous short positions becomes more expensive. Over time, this changes behavior. Hedges are rolled later, forward sales shrink, exposure windows widen, some supply that would normally be sold into the market is delayed. This is not because metal disappears, it is because the financial machinery that feeds metal into the paper market becomes less efficient. This is what many participants fail to recognize. Futures markets are not neutral mirrors. They are financing systems. When financing conditions change, behavior changes. And when behavior changes at the producer level, supply becomes less responsive. In a demand-driven environment, this dynamic can become powerful. Industrial buyers do not exit markets when financing costs rise. They continue sourcing metal, they renegotiate, they accept higher premiums, they build inventory. Their demand is anchored in production cycles. It is slow to reverse, but supply behavior can adjust much faster. And margin policy quietly pressures the most sensitive point in that system. This creates what can be called financial friction. Financial friction appears when normal supply channels do not flow as smoothly as price models expect. Inventories may still exist, contracts may still be written, but fewer tons are offered forward. Fewer positions are layered into the market. More risk is carried internally rather than sold externally. The result is not immediate shortage. It is gradual tightening. And tightening markets rarely announce themselves. They express through resistance, through dips that do not follow through rallies that do not fade, through price behavior that becomes increasingly indifferent to commentary. This is the phase silver appears to be entering. Margin changes, when layered onto this environment, function less as brakes and more as stress tests. They probe the system's tolerance for pressure. They reveal where financing structures are stretched. They expose where risk is already heavy. When margins rise and selling pressure does not overwhelm price, it suggests something important. It suggests that demand is not being easily displaced. It suggests that some sellers are stepping back. It suggests that the flow of available metal is less elastic than many assume. In markets where supply can be quickly expanded, these dynamics resolve quietly. Production increases, inventories stabilize, price volatility compresses. But silver is not such a market. Its supply system is complex. It is distributed across jurisdictions. It is embedded in other mining operations. It is slow to respond. And most importantly, much of it is not controlled by entities whose primary business is silver. This makes financial friction more impactful. When higher costs alter hedging behavior, they do not just affect traders. They affect mining companies, refiners, and distributors. These entities operate on thin margins, long timelines, and capital-intensive structures. When risk management becomes more expensive, it reshapes operational decisions. Over time, this reduces the willingness to pre-sell future production. And pre-selling is a critical stabilizer. It is how the future enters the present. It is how expected supply calms current markets. When that mechanism weakens, markets begin to rely more heavily on existing inventories and spot sourcing. This is when procurement behavior becomes visible. Buyers seek metal sooner. They extend contracts. They compete more directly. Premiums separate from futures. Delivery windows tighten. None of these developments require sensational headlines. They unfold in logistics offices, procurement departments, and financing desks. But their impact eventually reaches price. This is why serious observers increasingly watch margin policy not as a bearish weapon, but as a diagnostic tool. It reveals how resilient supply systems truly are. It reveals whether markets are being held together by financing structures rather than abundance. When prices continue to firm in the face of rising financial costs, it implies something uncomfortable. It implies that the system is not oversupplied. It implies that some normal sellers may already be stepping back. It implies that future supply is becoming less visible. And when future supply becomes less visible in a market with slow physical response, volatility rarely decreases. It builds. This phase is often invisible to the public because it does not produce dramatic charts. It produces stability. And stability in the face of rising pressure is often misread as safety. But in physical markets, stability can be compression. And compression precedes release. The silver market's current behavior increasingly reflects this pattern. Selling waves appear less effective. Price responses to negative catalysts weaken. Market reactions compress rather than resolve. These are not the traits of a loose market. They are the traits of a market absorbing stress. And stress, when layered onto structural supply rigidity, rarely dissipates quietly. It transfers into procurement urgency, into inventory behavior, into delayed hedging, into price. But margin dynamics are only the first pressure point. They matter because they touch the financing layer of supply. But beneath that layer lies something even more important: the physical reality of how silver is produced. And that reality introduces a far more rigid constraint than any exchange policy, one that cannot be adjusted with announcements or confidence, only with time. Structural rigidity, byproduct reality, and the illusion of quick supply. In financial commentary, supply is often spoken about as if it were a switch. If prices rise, production rises. If production rises, markets stabilize. This logic holds in industries where output can be scaled quickly. Silver is not one of those industries. The silver market is governed less by ambition and more by geology, infrastructure, and time. A critical reality often overlooked is that a large share of global silver supply is not mined because companies are seeking silver. It is mined because companies are extracting other metals. Silver is frequently a byproduct of copper, lead, zinc, and gold operations. Its output depends on the economics of those metals first. This structural detail changes everything. If silver demand rises sharply, miners cannot simply decide to double silver output. They must either expand base metal production or develop new primary silver projects. Both paths are slow, capital-intensive, and politically exposed. Neither responds to quarterly price signals. This means silver's supply system is not elastic. It is conditional. And conditional supply systems behave differently under pressure. When silver prices increase, they do not automatically summon new supply. They first increase the revenue of existing operations. Then they improve project economics. Then they attract financing. Then they enter permitting. Then they face regulatory review. Then they face community negotiation. Then they face construction. Then they face ramp-up. Each stage introduces delay. Each introduces risk. Each introduces uncertainty. Years can pass before a price signal becomes a physical response. This lag is not a temporary inefficiency. It is a permanent structural feature of the market. Over the past decade, this structure has been further weakened. Low prices discouraged exploration. Capital fled the sector. Projects were shelved. Skilled labor migrated. Equipment aged. Entire regional development pipelines slowed. These decisions were rational in the moment. They preserved capital. They avoided dilution. They reflected sentiment. But collectively, they hollowed the supply response. This is how structural rigidity forms, not through crisis, but through neglect. When a market spends years being ignored, it does not merely become undervalued. It becomes underbuilt. Its future capacity erodes. Its optionality shrinks. Its ability to respond to stress diminishes. This is the condition silver appears to be emerging from. And this condition reframes the behavior of miners. Many observers ask why silver miners have not yet surged alongside the metal. The assumption is that miners should lead, that equities should anticipate, that price signals should transmit instantly. But miners are not price instruments. They are capital structures. They depend on financing, liquidity, confidence, and institutional appetite. After long periods of underperformance, these elements do not return quickly. Capital does not rush into sectors that have disappointed. It approaches them cautiously, in stages, often quietly. Institutions rarely buy miners because charts look exciting. They buy them when risk must be repositioned. Their process is structural. They reduce exposure to vulnerable sectors. They manage derivatives and counterparty risk. They rebalance commodity exposure. They hedge inflationary input costs. Only after these phases do they begin building equity positions. This sequencing causes miner lag. Early in physical metal cycles, the metal moves because buyers need it. Miners lag because capital has not yet rotated. This lag is not weakness, it is inertia. In fact, historically, the most aggressive mining moves have rarely occurred during the early phases of commodity advances. They occur after neglect, after skepticism, after positioning has begun but narratives have not yet adjusted. This is why miners often appear broken before they appear explosive. From a systems perspective, miners sit at the intersection of two slow-moving forces: physical supply, which cannot expand quickly, and capital allocation, which does not shift emotionally. It shifts structurally. When both forces begin turning in the same direction, repricing rarely occurs smoothly. But before that moment, there is almost always confusion. Prices rise, but equities stall. Headlines remain indifferent. Coverage stays narrow. Analysts downgrade. Public interest fades. This disconnect creates the impression that something is wrong. In reality, something is loading. Structural rigidity in supply means that rising demand has nowhere to go except into price. Capital inertia in mining equities means valuation pressure accumulates without immediate release. Over time, this creates asymmetry. Small changes in sentiment begin producing large changes in price. Minor news events trigger outsized responses. Liquidity thins, volatility increases, gaps replace trends. This is the environment in which miners historically stop moving politely. They reprice. The most dangerous misconception in such phases is that delayed response equals permanent dysfunction, that a lagging sector is broken, that a neglected industry is obsolete. In reality, lag is often the signature of compression. Compression does not signal weakness. It signals stored imbalance. Silver's production structure ensures that imbalance cannot be quickly corrected. Capital's relationship with miners ensures it will not be quickly recognized. These two features together create a narrow passage through which repricing must eventually occur. And narrow passages do not permit orderly movement, they permit releases. At this stage, most market participants remain focused on familiar trades, mega capitalization equities, passive products, growth narratives. These structures have delivered returns, they feel safe, they dominate allocation models. But safety in markets is rarely permanent, it migrates. When regimes change, it does not announce itself. It expresses first in anomalies, in stubborn price behavior, in sectors that refuse to collapse, in materials that outperform expectations, in equities that fail to respond. Silver currently exhibits several of these anomalies. Physical demand signals appear firmer than commentary suggests. Financial pressure points are emerging. Supply response remains slow. Mining equities remain underowned. This combination rarely resolves quietly, and it rarely resolves without repricing the most neglected link in the chain: the miners. Capital architecture, narrative control, and the risk of disorderly repricing. Modern markets no longer function primarily through individual decision-making. They function through architecture. Capital is not guided only by human judgment, but by frameworks. Index construction, benchmark weightings, passive mandates, liquidity models, risk engines. These systems determine where money goes before most investors are even aware a choice has been made. Within this architecture, scale becomes power. When capital is concentrated into a narrow group of instruments, those instruments gain liquidity, stability, and political importance. They become system-supporting assets. Their performance influences sentiment, pensions, credit, and policy. Over time, the market begins to protect them. This protection is not explicit. It is structural. Flows default toward the same sectors. Coverage favors the same companies, conferences elevate the same narratives, research budgets follow the same themes. Attention becomes concentrated just as capital does. Resource sectors do not fit comfortably into this structure. They are cyclical. They are politically exposed. They are geographically dispersed. They rely on physical logistics. Their margins fluctuate. Their output cannot be optimized by software updates. Their risks cannot be smoothed by subscriptions. Most importantly, they link directly to the real economy. And when real economy constraints begin to assert themselves, they introduce instability into capital systems built on continuity. This is where firms like BlackRock become strategically relevant, not as antagonists, but as embodiments of how modern capital is organized. They design the products through which global savings are deployed. They construct the baskets that become default investments. They influence which sectors receive persistent flows and which remain peripheral. When resource equities remain small within these frameworks, they remain capital-starved. When they are capital-starved, development slows. When development slows, supply rigidity increases. This is not conspiracy. It is mechanical. The market, through its own efficiency, builds fragility. Fragility emerges when systems assume continuation, when they assume that inputs will remain available, that logistics will function, that substitution will be easy, that price signals will always produce timely response. Silver violates these assumptions. It is both industrial and monetary. It is both essential and neglected. It is both widely used and poorly incentivized to expand. This places it in an uncomfortable position within modern capital architecture. When such materials tighten, the tension does not express first in futures markets. It expresses in margins, in procurement, in logistics, in delivery risk, in financing stress, in hedging retreat. Eventually, it expresses in equity valuation. But equity repricing follows capital psychology, and capital psychology changes last. This is why mining equities often lag physical metals during early constraint phases. Capital does not move into neglected sectors preemptively. It moves defensively. It reallocates when existing exposures become uncomfortable. It rotates when old frameworks produce new risk. In these moments, money does not search for excitement. It searches for insulation. Resource producers become relevant not because they are fashionable, but because they become necessary. This is the condition under which violent repricing historically occurs. Not during optimism, not during promotion, but during realization. Realization that supply chains are vulnerable. Realization that inputs are tightening. Realization that old leaders are exposed. Realization that continuation is no longer assured. When these realizations emerge, they rarely align with tidy market behavior. They generate discontinuity. Miners, as an asset class, are particularly sensitive to such transitions. Their valuations compress during neglect. Their balance sheets are leveraged to metal prices. Their operating margins expand asymmetrically when metals rise. Their liquidity is often thin. This combination produces convexity. Small changes in metal price can produce large changes in equity valuation. Small shifts in capital allocation can produce large changes in market capitalization. When institutional flows finally arrive, they do not meet depth. They meet scarcity. And scarcity produces gaps. This is why minor repricing rarely unfolds as a smooth upward trend. It unfolds as phases of inactivity interrupted by sudden repricing events. Periods of boredom followed by periods of disorder. The danger for late participants is not missing gradual upside. It is encountering repricing environments that do not permit careful entry. This risk is amplified by the same capital architecture that delayed attention in the first place. Passive flows do not scale into illiquid sectors gracefully. They surge, they crowd, they retreat, they magnify. When such flows intersect with compressed valuations and tightening supply narratives, volatility becomes structural. This is the phase in which silver miners would likely transition from neglected instruments into system-sensitive assets. Their performance would no longer be optional. It would become explanatory. It would begin influencing broader market behavior, sector sentiment, and policy attention. Historically, this is when coverage returns. But coverage returns after repricing, after positioning, after capital exposure is already established. By the time miners appear regularly in mainstream analysis, the quiet phase has already ended. From a strategic perspective, the present moment appears positioned between these stages. Physical demand signals are firming. Financial friction is emerging. Supply response remains rigid. Capital remains concentrated elsewhere. Mining equities remain peripheral. This configuration rarely persists indefinitely. It resolves through repricing. The unresolved variable is not whether silver is strategic. It is whether the system will continue to treat it as non-essential long enough to prevent disorder. If capital frameworks remain concentrated while physical constraints build, resolution tends to arrive through adjustment rather than adaptation. Adjustment is gradual. Disorder is not. And when disorder emerges in resource markets, it tends to reprice the weakest links first. Not the metals, the producers, because they sit between physical necessity and financial abstraction. And when that bridge is forced to carry more weight than it was built for, it does not strengthen. It moves violently.